Hello, everybody, and welcome to Investing with IBD, sponsored by Direction. It's Justin Nielsen, your host here. And as always, every week, I have with me Arusha Pires from O'Neill Global Advisors. He's a portfolio manager there. And we're going to start out talking to you a little bit about the market. And in a little bit, we're going to bring on our special guest, Jeremie Capron. He's the director of research at ROBO Global, and we've had a lot of the ROBO Global folks on here before. Always a great conversation with them, so we're excited to have him on. But Arusha, how are you doing, and how are you dealing with this market?
I was probably doing a little bit better yesterday than today.
Exactly.
But honestly, it was almost kind of expected in this market. We've had a really strong run, and the Nasdaq moved right up to the 200-day moving average, and it's pulling back along with S&P. But the Nasdaq is the weaker of the two indexes, and it looks like both indexes are right around their 50-day moving average, and so now it's almost the moment of truth. We'll see how they behave at these key support areas.
Yeah, I mean, certainly what we were talking about on the podcast last week is, look, the NASDAQ had gone up 16, 17% in just a matter of weeks. You normally don't do that without some type of pullback or at least some sideways action. So the question becomes, how deep is your pullback? So right now we're right there at the 50-day moving average line, but we did get below the 21-day moving average line. And there certainly seems like there's a little bit of a defensive bent. I mean, the utilities and the consumer staples were the ones that were holding up a little bit better today. And hey, look at the utilities. I mean, that looks like a growth stock at this point,
Exactly.
But you have also the S&P 500 seems like it's at a crossroads, whereas the NASDAQ did drop below that 14,000 level. You have the S&P 500 right there at its 200-day line and its 21-day line. So we'll see if this is an area of support, or if we start pulling back more, it may require some more action. Anything to add on that?
Yeah, well, I would say if the markets can hold here, especially the S&P 500, they can hold around the 50-day and maybe go sideways for a couple of weeks. That would give more time for a number of these stocks that were building the right-hand sides of bases to put in handles, and then you could see some really constructive bases forming, and the market might be able to take another leg higher. So I think right now the market is saying stick with S&P 500 stocks, stick with more defensive stocks. And don't push it at this time. Let the market slowly pull you in. And right now, it's been slowly pushing you out the last couple of days.
Yeah, and it was certainly tough because a lot of the stocks that were driving the indexes higher were these beaten down stocks, whether it was the Chinese names or Twitter lately. I mean, it's just a lot of these stocks that were beaten down the most were having the biggest moves. So let's go ahead and we're going to step back a little bit. And for this, I want to bring Jeremie on from ROBO Global because there's a lot of different things that are kind of in the works here, and I'd like to get your take because we've got inflation, we've got the interest rate hikes, we've got you name it, a war in Ukraine. So what's your take, Jeremie? And by the way, welcome to the show.
Thank you. It's great to be back on your show.
So what do you think? Where do you start with the macroeconomic part here?
Well, I think the drivers of the stock market have changed quite significantly over the past few months. The last 2 years have been essentially about the recovery from the lows of the COVID lockdowns, dramatic policy response around the world, far stronger than ever in modern history. And the fiscal measures that were introduced in 2020, we estimated over 20% of global GDP, so really unprecedented. And so we've seen a pretty amazing consumer demand environment the last couple of years at a time of big changes in the economy. I'm thinking about the turbocharging of the digitization of the economy. You think about remote work, e-commerce, and so on. And now it's become increasingly clear that the monetary and fiscal policies have perhaps been excessive. Central banks are probably behind the curve. They're playing catch up with inflation. And now that you have this brutal war unfolding in Ukraine, war tends to be very inflationary. So the market's focused on rates and inflation. And in this kind of market, I think it's important for investors, first, not to panic. And at ROBO Global, we think the key to success is to focus on quality and to have a long-term horizon. So think about what the most important secular trends are, and make sure your portfolio captures them in a prudent way. What I mean by prudent is a diversified portfolio, robust portfolio, best-in-class companies, and that's, as opposed to making concentrated bets on hot stocks. And we think that automation, robotics, AI really is one of the most powerful secular trends out there.
Mm-hmm. And what do you mean by secular trend? Could you just define that for our listeners real quick?
Well, secular trend meaning a trend that has depth and duration. Mm-hmm. And when we think about automation, we think that these are the early stages of a massive wave of technology innovation to automate a great deal of the tasks that we humans do not want to do. And in the industry, we call those the 3Ds: the dull, the dirty, the dangerous. And in this inflationary environment, automation is kind of the go-to solution for many business leaders facing supply shortages in semiconductors, in components, and now in labor.
So, Jeremy, with this inflationary environment, and obviously with valuation coming more into focus here and becoming much more important in the overall market, especially since the end of November, what type of areas are actually, so if you're looking at a diversified portfolio, a lot of our listeners would say, hey, I'm kind of diversified in a number of different technology areas. They've all gone down, right, since November. What other type of areas are there some secular growth that they could at least have some of those areas start going up to have the portfolio balance out a little bit?
Yeah, well, when you think about this technology revolution that's unfolding right now around robotics and AI, those are fundamental technologies that can be applied to all industries. So it's not just about semiconductors or software stocks. I think you have to think about it as a technology wave that permeates every sector of the economy. And it started in manufacturing, of course, right? We put the first robots in automotive factories in Detroit in the 1960s. But in the past decade or so, we've seen robots come out the factory floor and start making a big impact in many different verticals in the economy. So you think about logistics and warehouse automation, you think about healthcare, think about food, agriculture, electronics, and so on. So you can diversify your exposure to this secular trend across a variety of economic sectors, right? So if you're taking a positive view on automation, you can build your exposure through a basket of companies that play across those various areas. And that will be a combination of technology stocks, but also software and hardware and industrial companies. And you're going to have healthcare companies as well. That's how you can build that diversified exposure to the secular trend.
Mm-hmm. And I guess, on the other side here, one of the things that has been driving this market so far this year has been a lot of the commodity plays, which seems like it would kind of be leaving AI and, robot. I mean, again, what do you do for oil? What do you do for gold, the metals, the miners and things like that? So is there, is it just, okay, you have your AI, your robo, your automation as one part of your portfolio, and then you have another part that's into these kind of hard assets, or are there ways where some of that automation is creeping in to some of these areas that are, again, kind of like your old stodgy, what you've been thinking of as industrial type companies?
Yes, Justin, I think that's a really important point. A lot of investors will tend to think that robotics and AI is all about super high growth, hot stocks. The reality is quite different. When we build the robo portfolio, we end up with about 40% exposure to industrial end markets. And here we are talking about much more cyclical businesses. Think about the machine providers, the factory automation, the factory robots, the control systems, and the likes. And those are heavily used in the materials industry, in mining, automating the extraction, the processing of ore and metals. And so, a lot of these stocks have not really participated in the really strong run in tech that we saw in 2020, the first half of 2021 as well. And so when you think about investing in robotics and automation, you actually carry quite a lot of those stocks. Think about the Rockwell Automation, the Siemens, the ABBs, the Fanuc over in Japan, and so on. And I think that's a really important aspect of investing in this area, is that you do not end up overly concentrated in one particular segment of the market.
Yeah. Well, you know what? This is a really interesting topic, and I think what we're going to do is get a lot more into this in the second segment, because I think that's where you can maybe dispel some myths on what investing in automation and AI really means in the current market. So stay tuned. We'll be right back. The Direction Hydrogen ETF offers exposure to the top 30 pure-play hydrogen economy companies by largest market capitalization, leading the way towards net zero emissions by providing more accessible, efficient, sustainable solutions across 5 hydrogen-related subthemes. With clean hydrogen-based energy expected to grow 5 times in the next 30 years, companies building hydrogen-related businesses to generate power, heating, transportation, and more will likely thrive. Okay, welcome back to Investing with IBD podcast, sponsored by Direction. It's Justin Nielsen here, along with Arusha Paris, my weekly guest, and our special guest, Jeremie Capron from ROBO Global, Director of Research over there. And Jeremie, one of the things that I was really just kind of surprised to hear, and this is not something I thought of, that you were just saying how exposure to industrial for the ROBO Global, the AI, the automation, the robotics, it's 40%. So I wanted to let you kind of expand on that idea, how some of these companies are using this automation. I mean, the factory robotics, I mean, that seems pretty clear, and you gave the automotive industry as an example. But with some of this extraction that you're talking about, what are some of the ways, and I guess some of the ways that the efficiencies are improving with using this automation and participating in this commodity move with some of these AI and automation companies?
Well, I think we're really at an inflection point in terms of the use of robots and autonomous systems to automate business processes, and that started in the manufacturing sector decades ago. However, at the time, capabilities of machines were fairly limited, and in the last decade or so, we've hit an inflection point in terms of the performance capabilities. You think about what are the enabling technologies that make robots possible. First is the sensing, the computing, the communication networks, and those are essentially exponential technologies that keep improving year after year. And so now we've reached a point where the performance capabilities are here, the costs are low enough that we can use machines in a host of different applications. But the core remains the automation of manufacturing activity. So you think about the factory robots, a traditional 6-axis robot that's going to be on a production line to make a car or make an iPad or electronic device in a factory. Around that, there's a variety of automation equipment and solutions that are also used. The control systems, the sensing, that's used for safety, the inspection, the quality of the finished products. And that's why, measured overall, you'll see that industrials remains the biggest application for automation. And now we have more emerging but rapidly growing applications around logistics and warehouse automation. I think it's really important that we talk about it today, because this is one of the solutions to the supply chain issues that we're facing of late. But you'll find applications in healthcare, like surgical robots,
Right.
or pharmacy automation. You'll find application in the food and ag industry and so on. And those are a growing piece, but the core remains around industrials.
So yeah, let's go more into the industrials, like with the warehouses, with because the immediate thing that came to mind was Amazon. I think it was a number of years ago buying that robot company, and then seeing some footage recently of all these robots are just kind of going all over the floors, picking up things, bringing it to some person to pack up. Talk a little bit more about that. Is it just Amazon doing that, or are more companies now forced to do that?
Yeah, I think Amazon's acquisition of Kiva Systems back in 2013, that's the year we started Robo. It really was a catalyst for to start an arms race around automating supply chains and warehouses. And what happened is that Amazon set the bar really high, not only for the e-commerce industry, but for the entire supply chain industry, in terms of being able to deliver products to your door, under 2 days after you click order. And that's a performance that's possible thanks to robots and automation. So today there's more than 300,000 of those Kiva robots roaming the Amazon warehouses and automating the fulfillment, the order fulfillment function. And if you look at the investment budgets of the likes of UPS and FedEx and transportation companies, everybody's really stepped up their game in terms of automating this work to please the consumer. The consumer has extremely high expectations today. And so the warehouse and logistics automation today accounts for about 13% of the Robo Index and ETF. It's been a growing piece, and it's been the best performing subsector of the index over the past 8 years since we started.
Mm-hmm. And because of you mentioned the labor shortage that we've been seeing in a big way, and of course that's part of one of the things that's caused, some people are saying a little bit of a inflationary environment. You also have these wage increases that are happening because, look, people had the Great Resignation, going on, and so you had all of these people kind of leaving their jobs, looking for something better, and employers had to pay up. So on this automation side, have you seen any companies or any, I guess, trends there where companies have been taking advantage of maybe an early investment in the robotics or the automation that has allowed them maybe a stronger position with this current labor shortage?
Yes, well, I think the Amazon example we just talked about is case in point, but we've seen many more in recent years. Another example is Shopify, who acquired Six River Systems, I think just about 2 years ago, just before the pandemic hit. And we've seen other smart companies like Zebra Technologies making investments around autonomous mobile robots. And I think the business leaders increasingly see automation and robotics as a competitive advantage. And if you track the money, you follow the money, in terms of M&A, for example, the sectors has been extremely active since 2018. In fact, over the past 8 years, since we started Robo in 2013, we've seen 25 of our portfolio companies receive a takeover offer. 25 out of a portfolio of about 80 plus companies. That's a significant number.
Wow.
Oh yeah, that's a big percentage. Yeah, I'm glad you gave the denominator there. That puts it in perspective.
What about the ag industry? How is automation starting to change that industry?
Yeah, I think ag is where automation actually started. You think about what our economy looked like at the beginning of the 20th century, and the majority of employment was in agriculture. And that's where humans started automating first, introducing tools and later on machines, and we all know the tractors and so on. And then we hit kind of a
dirty
plateau.
jobs, right?
Yes. Then we hit kind of a plateau in terms of the technology developments there. But again, in the past decade, we've seen some really interesting developments. We've seen the adoption of big data and analytics. And now I would say that the ag sector is at the cutting edge of automation, not so much in terms of the deployment, but in terms of the experimentation. So we're looking at companies that are using drones to observe crops and detect potential diseases that are starting to spread or the levels of hydration. We're seeing a company like Deere making really interesting acquisition like that of Blue River, which has developed a computer vision system that you put on the back of a tractor, and as you roll over the crop, you can analyze the health of every single crop and detect those diseases and the levels of hydration, potentially reducing your consumption of water or fertilizer or pesticides. So, it's happening in ag. Overall, as a in terms of the market capitalization weight of this activity was still in the early stages. And so food and ag represents around 5 or 7% of the Robo Fund. But we see that as a fast growing area for sure.
Well, and since we're on that topic, and that's interesting that you mentioned Deere, because I thought you were going to go with like the automated tractors, how they're getting into a little bit of the self-driving tractors, but that's a whole different element that you were introducing there. But we've had Nina on the show a number of times, and she's shared things on healthcare, but maybe you could touch on that a little bit, because you brought up the surgical robots, but every time Nina's on, there's all of these other things she's bringing up in terms of the trends in healthcare and automation that's happening. And I should also mention that healthcare just happens to be one of those areas right now that seems like it's holding up a little bit better and seeing more setups. So go ahead and give us your thoughts on healthcare.
Yeah, well, we think healthcare is the next big economic sector that's going to be profoundly transformed by technology. So we touched on logistics and warehouses and how that's kind of been the sweet spot over the past decade. Ag is probably a little further out, but healthcare is where it's happening now. And that's a huge economic sector, about 10% of GDP in the US. And when you think about it, we now have more than 6,000 surgical robots around the world's hospital, assisting surgeons in more than 1 million procedures last year. And we have AI that can help physicians increase the accuracy of their diagnosis when they are reading medical imaging or blood test results. We have 3D printed implants, we have miniature heart pumps, we have wearable devices for the monitoring of cardiac activity or glucose levels for people suffering from diabetes. We have gene sequencing. All this innovation has happened in the last few years and opened the door to an entirely new approach when it comes to healthcare. This is an approach where we're going to have a much more preventative approach than the current system, which is based on essentially, treating the sick patients. And that is a very costly approach. So I think there could not be a more exciting time for doctors, for patients, and for investors in technology around healthcare.
And so that's just getting started. How long do you think that's going to kind of scale up to where when you go in a hospital, that's what you're expecting to see, or how you get treated?
Well, I think it's really happening now. And that's why we launched a portfolio around that. That's the Healthcare Technology and Innovation Index, HTEC, we call it HTech. Right. Where all the examples that I just mentioned are actual examples from public companies that HTech ETF invests in. So you're touching on robotics, you're touching on lab and hospital automation, the data analytics, the ability to deploy machine learning on their health records, the patient records, on genomics data. Think about the telemedicine that came to the fore during the pandemic. Right. So I would say, Arusha, this is now. This is already there.
And maybe we could wrap up the discussion to kind of bring it back to some of our macroeconomic trends that we were talking about earlier. A lot of these companies, again, you're bringing up Deere and some that maybe have on the lower multiple side, but it seems like with this higher rate hikes coming up, a lot of people are concerned about these high valuations, that we see in a lot of these PE stock, these tech stocks with high PEs. And look, with a higher rate environment, you would expect there to be some trouble there. You would expect that multiple compression. So with a lot of these being kind of in that higher area, how do you kind of balance that out? Getting back to the diversification that you were talking about earlier, the high multiples with, are there areas of low multiples where the valuations are a little bit better?
Yes, I think the multiple compression in the most speculative areas of the markets already, happened to a very large extent in Q4 last year, Q1 this year, where we saw that the highest flying, tech stocks really coming back, crashing down, and in many cases, those stocks are back to valuations they were trading on before COVID and the turbocharging of digitization. So that's the first point I would make. And then the second really important point is that when it comes to robotics and automation, it's not just super high growth, high multiple stocks. And we touched on that earlier in the discussion. But yes, there are expensive stocks. Think about Intuitive Surgical trading on 50 times earnings, or ServiceNow, probably 50 times earnings as well. Illumina in gene sequencing, around 60 times. But they are the exception rather than the norm. In fact, if you look at the aggregate PE for the robo portfolio today, it's around 25 times, and that's bang in line with the historical average since 2013. So at the high, we hit 30 times. Now we've compressed to 25. And then there's also a lot of cheap stocks in robotics automation. I can see in robo stocks that are trading on PEs single digit. Cargotec, that's a leader in automation solutions for ports and shipping, or Duor and Kion in Germany. THK, Fuji in Japan, they're trading on like 10, 12 times PE. So in aggregate, that basket is not expensive.
Okay. Yeah, certainly. Again, very surprising, because you think of, again, the technology and you would think the high PEs, but as you've really demonstrated here, I think there's a lot of opportunities in those lower PE stocks and areas that have been working well in this first quarter of the year. So when we get back, we're going to hear a little bit more about some of the stocks that are on Jeremie's radar and get some of the details of why he finds them interesting. Stay tuned. We'll be right back. The Direction Hydrogen ETF offers exposure to the top 30 pure-play hydrogen economy companies by largest market capitalization, leading the way towards net zero emissions by providing more accessible, efficient, sustainable solutions across 5 hydrogen-related subthemes. With clean hydrogen-based energy expected to grow 5 times in the next 30 years, companies building hydrogen-related businesses to generate power, heating, transportation, and more will likely thrive. Okay, everybody, welcome back to Investing with IBD podcast, sponsored by Direction. It's Justin Nielsen here, along with Arusha Piras, and our guest today is Jeremie Capron from ROBO Global. He's the director of research there. So, Jeremie, you've been talking a lot about ways in which automation has been changing some of these companies. Again, not necessarily the high-tech companies that you think of when you think of AI and automation, but the manufacturing, the industrial. And do you have any names out there that kind of will, I guess, put an exclamation point on those points that you've been making with us earlier?
Yeah, well, look, I think some investors are very familiar with the usual suspects, like Intuitive Surgical in surgical robotics, or NVIDIA in computing and AI. But in fact, a lot of the tech and market leaders in robotics and AI are still small and mid-cap companies that most investors do not own. In fact, the overlap between Robo and the S&P 500 is less than 3%. So most investors don't own these stocks. And I that's why I want to discuss some of these smaller stocks that maybe are not on your radar.
Okay, where do you want to start?
Well, we talked about warehouse and supply chain automation. So I want to start there and talk about GXO Logistics. That's a fairly new public company that spun off XPO in July of last year. Came out the gate very strong.
Mhm.
Stock went from 55 to about $100 in just a couple of months. Peaked in November, now down to the low 60s. And that's a member of the Robo Index and ETF. And so what GXO Logistics does is that we call that contract logistics. So they provide automated supply chain management for multinational companies, blue chip companies like a Nestle or a Nike, who choose to outsource their logistics to specialists for higher efficacy, higher productivity. And so GXO is building very high-tech warehouses around the world. They use cutting-edge technologies like robotics, computer vision, autonomous mobile robots, and so that helps their customers increase the productivity of their supply chain operations. And I think there's a really interesting angle around how the warehouses of the future can enhance the environmental performance of businesses and the sustainability of businesses. So we look at GXO. That's a company we expect can grow revenue in the double digits per year through share gains, the boom in e-commerce to which they're very geared. In fact, more than 50% of their revenue is coming from e-commerce.
And so like I remember going and taking a look at this company when it was spinning off, and I like that it was part of XPO, because XPO has done very, very well over the years. So in many ways, so this is essentially just leveling maybe the playing field versus an Amazon, where Amazon's invested all this money. Now some of these other companies can go and kind of get those efficiencies. Is that how you look at it?
Yeah, I think it's really an opportunity for large companies with broad, networks of facilities or distribution. So
Okay.
again, think about multinational that realizes they can find somebody who can do that better than they can.
Okay.
And so that's the trade-off. And right now, it looks like this trend is gaining a lot of traction in recent years. You can see the portfolio of clients at GXO is growing, and then their share of the the spending for their customers around supply chain automation keeps growing every year.
Mm-hmm. So just on the technical side, again, this came out of the gate really strong, but really since November, since its peak in November, it's been really not participating, and that seems strange to me, given that we still have all of these supply chain issues, potentially more disruption from the war in Ukraine. And look, the numbers here are pretty good, as you mentioned. It's got double-digit growth, and the earnings have turned around from losses, and now it's got profits, some very strong ones. What is it? Why is this not in favor right now, do you think?
Oh, I can think of two potential headwinds that push the stock down. Number one is, what happens with a spin-off. Some of the institutional investors end up with a stock that may not fit their mandate.
Mhm.
Right, it's a growthier stock than XPO, and so a few months after the spin-off, you can see some portfolio rotation, and that can be a headwind. But number two is also their large European exposure, and Europe is probably one of the toughest of the big economic regions right now, given the developments with Russia and the soaring energy costs. I think investors are more cautious on Europe exposure right now.
Mm-hmm. Makes sense. So moving on, you mentioned earlier a company that a lot of people may be familiar with, Zebra, and this one, this one's been out for a while. It's been on our radar at different times. Maybe you could talk a little bit about what it is that Zebra does.
Yeah, ZBRA is also a member of ROBO. That is the top player in what we call asset tracking. and other track and trace solutions for supply chains. So they make things like a barcode reader,
Right.
radio frequency ID, mobile terminals, and all sorts of technologies that are used to optimize supply chains and warehouses. So they also play into retail, healthcare facilities. And I think they're becoming the go-to provider of automation for moving goods or parts in a supply chain. And that's a very well-run company that a lot of investors have not heard of because it's still, just around that market cap level. And even though they make, I believe, between $5 and $6 billion in revenue today, and last year they grew their revenue by more than 25%. They're making some very smart investments in robotics. They have acquired Fetch. Fetch is a mobile robot company based in the Silicon Valley. They bought that last year for around $300 million. They're also pushing into computer vision that we talked about earlier. They just announced the acquisition of Matrox Imaging for almost $900 million. And this has been a very good investment over the years. You can see the quite rapid and steady compounding in Zebra stock. It's like quadrupled over the past 5 years. And recently it's pulled back from around $600 down to $400. And today trades around 20 times earnings. So that's below the average for the members of the Robo Index.
And with Zebra now, do they compete with like an Impinj, or are they working with them? Because Impinj, I think, does they're involved in the RFIDs too, right?
Yes, and barcode printing. Yes, absolutely. But Zebra is by far the largest player today in the market in what we call automatic identification technology. They're number one. Number two would be a Honeywell, one of the
Yep.
Honeywell divisions,
Yep.
and Impinj would be quite further down the rankings.
Mm-hmm. And I always thought it was just really interesting the name that they came up with. When you look at a barcode, that zebra type
That's
look of
true.
a barcode. I always
Absolutely.
thought that was very clever. So we have GXO. The ticker symbol on Zebra is ZBRA. Anything else that we should know about this one?
About Zebra?
Yeah, before we move on.
Yeah, I think there's been this perception for quite some time that Zebra was overly exposed to brick and mortar retail,
Mm-hmm.
which, as we all know, is losing share to e-commerce. And
Mm-hmm.
I think that's why, for some time, the stock kind of languished, a few years ago, because of that perceived risk. And in the last few years, Zebra has really demonstrated that not only are they not overly exposed to brick and mortar, but they are very exposed to e-commerce and the warehouse
Right.
automation around that.
Mm-hmm. And is it, again, I would imagine their products are really kind of helpful with that inventory control, inventory tracking, and again, moving it no matter whether it's from warehouse to warehouse or from warehouse to consumer, what have you, just keeping track of where everything is going.
Yes, we call that track and trace. This is one of our areas of focus in terms of warehouse automation in the RoboFund.
Mm-hmm. Very good. And so let's go ahead and round out the conversation with another one. You were talking about some of these companies that have the sensing, because that's a really important part of automation. So let's go ahead and take a look at CGNX, Cognex. What is it that these guys do?
Okay, so Cognex is a leader in computer vision. And computer vision is about giving machines the ability to see and to
Mm-hmm.
analyze and understand what's in a digital picture, right? So for decades, computer vision was extremely limited, too expensive because it requires enormous compute power.
Right.
And in the past decade or so, researchers and companies like Cognex, they've made tremendous progress. And they've developed what we believe is now a more than $10 billion market that's around using computer vision to improve manufacturing process. So it's about factory automation.
Mm-hmm.
And so in the past 10 years, Cognex has gone from $300 million in sales to just above $1 billion last year. And their systems are used at factories and distribution centers for e-commerce. So, Amazon, Apple, BMW, Unilever, all sorts of big players are now using the Cognex technology to inspect and identify products or parts in their manufacturing process. Now, what's really interesting about this is that they've recently launched a new series of products that are powered by AI. And that we believe can significantly expand their addressable market. Most computer vision systems today are built around algorithms that are rule-based, that are designed to help computers understand what's in the digital picture. This new approach, AI-powered approach, used a deep learning. And that could address many new applications, especially around inspection problems, where the algorithmic approach cannot easily be applied. So think about detecting random imperfections on a metallic surface or on plastic. And this is a huge part of the human's work in manufacturing today is inspection.
Yeah.
Today, we think there's about 35 million manufacturing workers that are specifically focused on visual inspection tasks. So using that kind of technology can be a huge relief in the industrial sector.
I almost feel like even with all these names, especially Zebra and Cognex, if you don't have these technologies, if you're a manufacturer and if you don't have these technologies, you're going to get left behind really quickly, especially once machine learning starts coming around and starts to detect these flaws during the cycle.
Yes, I think we've gone from a technology that was overly expensive and clunky to computer vision that's become affordable and a nice to have. And today, they've become necessary to compete in the global marketplace.
Yeah, and again, one of the big catalysts there, as you said, it was really kind of it almost needed that other technology to change, the computing power, that's driving a lot of this AI and the deep learning. That just wasn't possible 10 years ago. I was going to get into a tangent here about another cousin that I have that is, was explaining to me in the 80s and 90s about computer recognition, and how difficult it was, because again, it was very algorithm based. You had to kind of teach the computer what it was looking at, and it was just very complicated. And if it's able to kind of learn about those imperfections on its own, I mean, that's just such a game changer that's been opened up with the new technology. So yeah, really appreciate you putting a lot of these on our radar. Jeremie, it was really nice having you come on the show again. We're always so excited to have the ROBO Global folks on. You're always sharing so much great information with us about some of these companies, the excitement that's going on, and it always makes me remember just the sci-fi novels that I used to read as a kid. It seems like more and more where we're going, right?
Well, thanks for having me.
Okay, it was a pleasure. And on the show next week, we are going to have a little bit more of we time. Arusha and I are going to tackle things on our own, see if we can be trusted to be on our own. So we hope you stay tuned for that. And thank you very much for watching us this week. Take care. Make sure to subscribe, rate, and review our podcast if you haven't already. We'd really appreciate it. You can also send us your questions and comments to investingpodcast@investors.com. We would love to hear from you and may use your comments on an upcoming episode.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.